Welcome to our YouTube live, and you can probably tell I'm wearing my t-shirt from Denmark. So this is Christiania. It's kind of interesting place to visit if you do get to Copenhagen. Weirdly, I'm a finance YouTuber, but it's a little bit of an alternative hippie commune where people have looked at alternative ways of living. So, I just thought that was fascinating. I'm also really interested in cooperatives. So I just find these things different. So by definition, interesting. But a couple of things to mention at the beginning of today's live stream. The first one is that there was a question at the end of the previous live stream. I don't know why, but people often ask a question in the last 5 minutes, and I don't look at it. So we've carried this one forward. But also, I've got to say, like and subscribe if you do like our content, and you're not subscribed to our channel, please do. And also to mention the Many Happy Returns podcast for this week, which is about stocks and bonds. So you can get it on YouTube, you can get it on Spotify, you can get it on Apple Podcasts, wherever you get your podcasts. Many Happy Returns is the name of the podcast. I'll see if I can put it up on YouTube. Yeah, here we go. And it's going to start talking, so I'll stop it. Where we go. So this is what it looks like. Many Happy Returns, and who wins the next decade. So it's stocks versus bonds. Now, the conventional wisdom, of course, is that stocks beat bonds over the long term. But over the next decade, there are quite a few fund managers who've come up with 10-year forecasts, like Vanguard, for example, but also fund house investment research from Goldman, which suggests that the risk premium, which is the amount that equities give you above the risk-free rate, i.e. what you'd get with bonds, is negative. In other words, bonds are going to outperform equity over a decade, which is pretty shocking. So we talk about that, reasons behind it, reasons why it might not happen, and some of these forecasts which have come up with this pretty radical suggestion for the next decade. Now, have I changed my allocation as a result? No, I'm afraid not. I never do. But that's our Many Happy Returns podcast for this week. Small weird news item. Last time I asked you about my camera, my EOS camera. This week I managed to, I think I've destroyed my my Elgato digitization thing. Let me show you actually. This is hopefully someone from their company is actually watching tonight. But what I do is I take my my DSLR output and I put it into one of these Elgato 4KX digitizing thing. So what you do is you plug in the HDMI and then it's got a USB-C output, and I've been trying to improve the quality of the videos. So, I'm trying to use the video in high res mode, but the autofocus didn't work. And then finally I got the autofocus working, and this thing packed up. And it's the second one that's packed up. I had the kind of little pen fob version previously. I've got a whole gallery of these things. Look. So this is the Camlink one, which I had previously. Also died. So, yeah. So if Elgato's watching, sort yourself out. So, bit of a nightmare today. But this is my trusty and reliable Insta360. So, where the autofocus works perfectly. It's brilliant. So, first question is from last week. Last time we had one of these, which is from Philip C. It was a super chat. Quite a generous one. I thank you, Philip. And the question, which is kind of interesting, is: do you think Bitcoin will reach $1 million one day? I have 2% of my portfolio in it. Now, what you haven't said there is when. And the reason why that matters is because, well, if it takes 10 years to get there or 20 years to get there, then obviously the return is not so high as if it got there quickly. So you could say that about any investment. Will it reach $1 million or a fixed level at some point? And an interesting thing about random walks, which is what many assets are, is that they visit every value an infinite number of times, which is also interesting. So the answer is yes, it will get there if it carries on having value. If it gets superseded by something else, if it gets wiped out, then clearly it's not going to get there. But if it didn't get there, over a long period of time, then effectively it would be because its value had gone to zero, which could happen, let's face it, because it doesn't generate income. So it has no fundamental value. It's only worth what people think it's worth, kind of like gold in that sense, but without the pedigree. So yeah, I think it will reach 1 million one day, $1 million, but I think it could take a while to get there, because if you look at the return of Bitcoin, clearly when it was new, and it's only been around for a decade, just over a decade, the returns were unbelievable. The reason why people are interested in Bitcoin is, like, let's face it, not because of some libertarian dream, it's because its value goes up hugely. So it's because of speculation. And I think that's true for most people. And if you look at the actual return, it's not as blisteringly high as it was in the past. And if it was as blisteringly high as it was in the past, if it hadn't behaved like a penny stock, if it carries on behaving like a penny stock, then imagine what would happen to capital markets. We'd end up with a disproportionate amount of capital in essentially a dead asset, which doesn't generate any value for society. And that was starved capital from companies and from bonds, which after all are used to keep hospitals going, to keep to build bridges, to generate services and goods that we like, all these kind of commercial goods that we use, including the ones which don't work very well. All of those are paid for by capital markets. So if we're going to starve the capital markets with Bitcoin, by Bitcoin absorbing all that capital, I think that's a real problem. So, I think there are various reasons why the returns in future may not resemble those in the past. And I think a large amount of the huge returns that we saw were largely due to the fact that it was new. Money was flooding into it, and that's what pushed up the price. Because scarcity, remember, is not the same thing as value. There are many things which are scarce, which don't have particularly high value. It's only worth what people are willing to pay for it. So, yeah, I think it probably will reach $1 million one day, but I think it may now take some time to get there. But look, who knows? Who knows what the forecast is going to be for Bitcoin? I don't think anyone does. Whereas at least for equity, you can look at the historic returns and you can have a fairly good stab at what those total returns will be in future for a global index, say. Of course, you never know, but you can look at the drift rate in the past, how quickly earnings have grown in the past historically, and roughly what that'll entail for the future, assuming there isn't a disaster, of course. So, yeah. There we go. And we also have another super chat now. Thank you. This is from ENP. Thank you very much for that. And they say, is it true that OCF's, so that's the ongoing charges figure, like the total expense ratio of funds built on solo active indices will reduce over time, as solo active charges manufacturers a flat fee, whereas others charge a percentage? Yeah, I think that is true. And I think the reason why many fund managers have chosen solo active is because it's a cheaper index provider. And that would be reflected in the actual expense ratio of the funds. So that's why also some fund managers have created their own indices. Ostensibly, this might be because it's a thematic index and there isn't an index for that particular thing. But how hard is it to come up with an index? Well, there are certain regulatory requirements. If you have an index which is tracked by money, then the regulator enforces certain criteria about how often it's calculated, who calculates it, how it's calculated. That has to be completely transparent. and documented. So, there is a certain regulatory hurdle in order to create an index, but many of these companies have easily got the resources to do that. BlackRock does, Vanguard does. So I'm surprised more of them don't do this. But maybe it's the fact that they just want something which is objective, widely agreed upon, and that's why they go for a standard index like the ones from MSCI or from FTSE Russell. But yeah, I think that's an interesting point, really interesting point, ENP. And I think that, that's one of the reasons why the fees for these solo active tracking funds are often quite low. From memory, I think the Fidelity Global Fund P, is it P or B? Yeah, the very popular, Fidelity Index World Fund P. I think that tracks a solo active one. But certainly some of the larger fund managers do track those indices, and I would expect the fees to be lower. But I didn't know that it was actually a fixed fee. I didn't know that it wasn't a percentage. In fact, I'm not sure how MSCI charges or how FTSE Russell charges, whether it is a percentage of the AUM. I mean, certainly the fund manager charges a percentage of AUM. So, if they did manage to get an index company to charge them a fixed fee, that would be a bit of a coup. But that's the way I actually assumed that these things were charged. I'd love to know the source of that information, ENP. If you pop that into chat, maybe I could look that up later. That's really interesting. Thank you for that. Really interesting question. I mean, it's great. Sometimes I find out things during these sessions when that I didn't know before. So one thing I didn't do at the beginning, actually, because I was whining about my Camlic thing, is talk about markets. Now, the big move recently is to do with the next super chat, which is to do with gilt yields. Now, what we've seen generally over the last, very quickly in 2022, and now not so quickly, is yields grinding higher. So there's a nice article about that from Rob Armstrong, who does the podcast with Katie Martin. And let me just quickly share that. So this is a nice graph because it shows you developed market yields over the course of the last few years. So the one at the bottom here, of course, is Japan, but that's creeping up inexorably, as are the others. These are long-dated gilts, right? So these generally price in expectations about growth and inflation. Higher growth, higher inflation expectations means high yield at the long end. Now, at the short end, what we're seeing is gradually yields falling in many regions, in developed markets at least, except for Japan. So what we're seeing is a steepening of the curve. The long end's moving up, the short end's gradually moving down, and we're seeing more term premium. But you can see that it's not just the UK where yields have been rising. The three bond markets shown here for France, the UK and the US are pretty much tracking each other up. And France in particular is worrying because people have talked about debt sustainability there a lot recently. But it's not just unique to any one of those countries. The excuses or the reasons people give for those yields rising in each country are different, which is interesting because you can see that these are three different manifestations of the same process. But in the UK, people say it's because people are worried about the coming budget. But you can see that, this has been a steady increase over the course of a couple of years. It's nothing to do with the budget in particular, I don't think. Or in the US, it's about Trump fiddling with the Fed, firing one of the Fed governors, or trying to also questions about the deficit in the United States, which remains persistently large. So the debt to GDP carries on increasing over time. So debt sustainability in the US is also a concern. Whereas the UK, it has to be said, Rachel Reeves is obsessed with keeping debt to GDP constant over the term of her kind of over the next parliament, over the next 4 or 5 years. So the UK is being really careful when it comes to not spending more than it earns, which means that this budget's going to be very difficult, the one in November. But if it was the case that people were worried about debt sustainability, well, the UK wouldn't have sold off as much as the others. So I don't think there is a clear-cut reason why the UK and the US and France have all seen their yields increase. Term premium, remember, essentially is because people want to be compensated for taking lots of duration risk. Now, in the UK at least, defined benefit pensions have shrunk dramatically, and these are pensions which are linked to your final salary. Now, those have piled into gilt historically, but as the members of those schemes die, then their assets shrink. And so one of the natural buyers of this long-dated debt is essentially disappearing. So that's going to put a structural upward pressure, long-term upward pressure on UK yields. In the US, I don't think it's as clear. I think people are more worried about central bank independence, inflation, with the tariffs. And I think that's probably dragging UK yields higher as well. And of course, in France, people are concerned about debt sustainability and the persistent deficit and the huge spending of the government, which is just probably unsustainable. So I think it's a combination of those factors. I don't think it's just one thing which is pushing these yields higher. Another thing, I think your question is an interesting one, which is how high could they go? Well, let's look at history, because for the US, we've got about a bazillion years of long-term yield. So this is from FRED, the Federal Reserve Economic Database. So these are 30-year constant maturity US Treasury yields. And these go back all the way to 1977. So that's even before the Volcker ultra-high inflation period. And you can see that they reached at their peak something crazy like 15.2%. In 1981, in August of 1981. Of course, we're nowhere near there, but of course inflation's much lower at the moment, and these do bake in inflation expectations. So if inflation expectations got out of control, and remember, that's one of the concerns at the moment with tariffs, particularly if the Fed is going to say, you know what, if inflation increases, we'll just keep rates low because that's what people want and that's what the president wants. If that happens, yeah, could we go back to 15% inflation? Of course we could, because no one gives a damn about inflation as much as the Fed should and does at the moment. And that's why it's important to have an independent central bank to stop inflation going to 15%. So that's why it worries me to see Fed governors being fired, threats against the Federal Reserve chairman, independence of the Federal Reserve being eroded, because of what it means is that we can go back to those crazy yields. And that kind of thing can sink a government, because imagine the debt servicing cost if instead of paying, 4% on its debt, the US has to pay twice as much, 3 times as much. That's going to be a real problem. It can probably still afford it, but it's going to be a real struggle. And that's money that can't be spent on things like, running the country, infrastructure, defence, all of these things which a country needs. So that's what worries me. And that's why having a central bank which is independent is important. And these changes recently have been very worrying indeed. So how high could it go? Well, that high. But hopefully that won't happen, right? I mean, what's happened so far is we've seen this taco trade where Trump chickens out, and it's the bond market that's made him chicken out repeatedly. So hopefully that happens again. Next question is, I think Laura said this helpful comment. Here we go. Living Life's Adventures. This is the person who made the comment. Elgato device is often required to first start the Elgato software and then the OBS software next in that order. Then removing the camera in OBS and re-adding it with Elgato. I'll give that a go. Believe me, I've tried everything today. And it all works seamlessly until literally today. When I was changing the resolution of the output. Maybe that's what caused it. Maybe it's a combination of frame rate, which is now lower, and resolution, which is lower, which it can't handle. Maybe that's it. But it worked for a while and then it stopped working, which is odd. Right, so back to your questions. I mean, other market changes, obviously, we've had sterling weaken a lot. That, I think, could be put down to people worrying about what's happening to the UK budget. But yeah, I think equity market, not a huge rally this week. Another kind of interesting thing, you might find this interesting, I don't know, but let's have a go. So this is an experiment I'm running, which is a global efficient core portfolio. So what I've done is with 1 year's ISA allowance in my fund portfolio, what I've done is I've created this leveraged 60-40 portfolio, and I've done return stacking, which means that you use leverage 60-40, but it's 1.5 times levered. So if I've got £100 to invest, I put £66 of it, £67 of it into this 1.5 times levered core. And that gives me the same exposure as if I put £100 into 60-40, global equity, global bonds. But that means I've got £33 left to spend. So I can stack another return on top of that return, which is what I would have had with a 60-40 portfolio. Now it's critical here that you don't do risk stacking. You don't just double down on risk and buy more equity. You buy something which is uncorrelated to the stocks and the bonds. So what I've chosen to do, and if you watch my video about return stacking, this is the example portfolio I used. I've got 67% in this WGEC core, Global Efficient Core Fund. I've got 18% in this Enhanced Commodity Fund. And I've got the remaining 15, I think, in this physical gold ETF. Now it turns out that about 2 percentage points are added to the gold from the WCOB fund. So overall, it's roughly equal amounts gold and other commodities. And the other commodities are dominated by energy. But it's got things like copper in there and industrial metals as well. And I think some agricultural stuff. But this is the breakdown of my returns for those three components since I put the trade on in June. And what's interesting is this gold spike, right? Because I was a little bit nervous about buying gold because the price was so high. Our fundamental model was telling us it was expensive. But in fact, that's been the best performer so far. Well, second to levered 60-40, which is up 7.5. The broad commodities, not so good. And I suspect a lot of that return is due to the gold rally. So people are nervous. You can tell that from the surge that we've seen in gold. Now my core is in global equity in ACWI. So that portfolio is up 5.8% in the fund portfolio in this levered 60-40 portfolio, whereas global equity is up 8. But I thought that was kind of interesting. You know, you get the upside, but it also protects on the downside because of the gold exposure. So I just thought I'd share that with you because I thought it was kind of interesting. Oh, wrong camera, the one that's not working. Don't want to use that one. Brilliant. Back to your questions. Okay, no super chats, so we'll go back to here. Oh, and that was the next question actually. What are your thoughts on holding a small amount of gold in a stocks portfolio purely to increase overall return because of the slight negative correlation? Well, the expected return of gold is an interesting one. You'd expect it to track inflation. You'd expect any commodity to track inflation. And that's because if it's useful, it has to track inflation. If it didn't, if it was under inflation, if its growth in price was less than inflation, it would just become ridiculously cheap, essentially free, long term. And if its growth was faster than inflation, it would become prohibitively expensive, and it would probably get substituted by some other commodity. So those are the reasons why most useful commodities would be expected to track inflation long term. Because it's got a negative carry cost, gold is a wasting asset. If you own it, it costs you to store it. It doesn't generate an income. So that's one of the drawbacks with it. And that's why it's toxic if interest rates increase, because it makes gold less attractive. If you can own a treasury which pays you 5%, 6%, and gold pays you nothing, well, gold is suddenly much less attractive. That's the logic behind it. But what gold does, as we saw with that portfolio just now, is it provides a hedge. So it's uncorrelated, or usually uncorrelated, with equity markets and with bond markets. So if those two fall together, and there are lots of reasons why that might happen, could be an inflation spike, could be a debt default threat from the US government. Surely that would never happen. But those kind of things would make equity and bonds fall together. So the bond hedge would break in those environments, but the gold one wouldn't. So that's why I think that's an interesting diversification. So broad commodities as well. One of the things which causes inflation spikes is often energy spikes. So that's why the broad commodity fund would also be interesting to hold alongside the gold. So I think in retirement, when these kind of drawdowns and extreme scenarios would affect you quite adversely, not during the accumulation phase, but in drawdown, I think that's when it becomes interesting to have these alternatives. Because the more choices you've got about things you can sell which haven't crashed to live off until equity markets recover, the better. And the greater the chance that one of these things would hold up. So that's why I think in retirement, these are the kind of things that would be useful. Commodity funds, gold funds, they give you that extra optionality. During accumulation, I'm not convinced gold adds a lot. Of course, it's done really well recently, but that's for very specific reasons, right? Long term, I would expect its return to be roughly in line with inflation. Whereas, if we look at long-term returns, let me share this with you. I always keep the spreadsheet handy. So this is the Dimson Marsh Staunton returns from their latest report. So this tracks total real returns over the last century and a bit for the UK, the US, both in nominal, that's not inflation adjusted, and in real terms. So whereas commodities would roughly have a real return of 0, equity over that period of time for the US has had a return of just under 7%, in the UK just over 5%, so much, much better than you'd expect with commodities. Bonds about 4% less than equity, and cash-like investments like money market funds or bills, T-bills, they've generated between 0.5% and 1% above inflation. So weirdly, cash is actually quite a good inflation hedge. It picks up the rate of inflation plus a little bit of extra return fairly quickly because it's got 0 duration or very short duration. So yeah, gold would be at the bottom of this table. That would be my expectation. So I wouldn't buy it for the return, I'd buy it for the diversification. Okay, next question. How are we doing? Halfway. So we'll probably invite Ted up at some point. Now normally I think I get Ted up here when oh my goodness, I'm out of treats. God, he's going to be so miffed. 1 second. Oops. Whoa. Right. So, I'm going to have to open the packet while we're watching. Right. Ted. He's going to the bin. It's not there, mate. These are his special burger treats. He's been so good recently, he's had a lot of them. There we go, Ted. Loves these. I'm not sponsored by these guys, by the way. Although one of my clients was a pet food maker. Fascinating business. There we go. You're going to have to earn it. You're going to stand up? Do a trick. You're going to stand? I can only see it. If you come a bit closer. Yeah, good boy. Good boy. Brilliant. Well done. Good lad. Back down to Laura then. She's got built on. And we've got another super chat from Canada. Thank you, Alp Marangos. I often think these names mean something and I haven't got a clue what it is. Go on. Biltong, downstairs. Yeah, there we go. Does everyone investing in passive funds freeze the index composition? Would every index fund investing in Tesla make its position permanent? Oh, that's interesting. So how does the index composition get decided? Well, firstly, there are inclusion rules for each index. So there are certain criteria which a stock has to fulfill in order to be a member. There is an element of subjectivity. So, for example, the S&P 500 is determined, its contents are determined by a committee. In order to get into the S&P 500, you have to be profitable, for example. But once you're in, I think it's down to the committee whether you get thrown out. And there are certain reasons why they would throw a stock out. I mean, if it's a fairly liquid, important stock, they probably keep it in, even if it was pushing the boundaries of eligibility. But that's how. So it's certainly not the case that once you're in permanently. That's not true at all. And in fact, there are index removal events all the time. If you work at an investment bank and you work in the front office, you often get emails from the index companies saying, you know, this is an inclusion event and a removal event for this index. So you know you're told about this before it happens. If you work in the finance industry. So, but the reasons why it might happen, a company might fall out of favor and its market cap might shrink. So let's say that Tesla went bust, or less spectacularly just became kind of not very big company. If that happens, then it would just glide down the rankings of market cap until its weight becomes so low that it would probably be considered for removal. So that does happen to companies, but usually what happens, the way they die, the way they disappear, is either via merger. So if Tesla became really cheap, one of its competitors would buy it, and then it would just be cease to exist, it would die. Or it could go bankrupt. So that would be another reason for removal. But it is a kind of living, breathing thing, an index fund. You know, it's always churning, it's always moving, it's always kind of dynamic in that sense. Like looking at a woodland or looking at the sea, it's always interesting and it's always in a state of flux, because the fate of different companies changes over time. If you were to go back 100 years, it would be railway companies that were a big deal, or steel companies. and before that it was canal companies. Every generation has its own exciting new technology. Now it's AI and tech companies. Who knows what it's going to be in future? Maybe quantum computing, maybe something to do with nanotechnology, or high energy superconductors and the spin-offs of that. That could be really transformative. If you could transmit power with zero loss over crazily long distances, well, then you could essentially generate power where it's abundant and use it where it's required. And a lot of I think that would be very transformative. So that's another thing that would be very important, I think, and which would move the markets a lot and change the leadership of markets a lot. But all of these things come and go. They wax and wane. But by no means is it the case that the tail wags the dog. So obviously, if there's a lot of money indexed against, if there's a lot of money that is used by funds which track a given index, then yes, at the margin, that pushes up the price of those stocks. But ultimately, what drives the price of the stocks is their profits. You can't have a stock which is, rising forever faster than its profits. If it did, we just had multiples that were crazy. And in the case of Tesla, the multiples are crazy. I think it's purely held up by euphoria. And I don't know what the latest forward price to earnings multiple for Tesla is. It's over 100. Let's just pull it up. Who's got it, I think. So the forward P is 132. So now you'd expect it to be something like 20 times or 30 or even 50 times for a normal tech stock, but Tesla's always been way out there. But that's euphoria, right? But ultimately, what drives stocks higher is going to be profit growth, and so that's what moves stock prices. It's not the indexes themselves. Certainly not for the large caps. Maybe for the small caps when they're being included or excluded. There is an effect there. On the day of inclusion, you get a bump in the price, and then it kind of tails off. And if it's excluded from the index, then you'd expect the price to fall. But that's not the primary driver of stocks, and I suspect it never will be. Okay. Oh, we got another super chat. Thank you. This one in pounds. Thank you, Rajaseelan Ganeswaran, a frequent flyer for the PensionCraft. Thank you. Rajaseelan says, for factor investing, how long should we generally stick to a strategy to get results, i.e. momentum ETFs? Well, I mean, a strategy which probably wouldn't work would be to swap between one factor and another, because by the time you switch, there'll be, it may not be that you'll switch in time, and that kind of factor switching strategy is very unlikely to work. So I'd say find a strategy that you kind of could stick with over a long period of time. I've frequently said that I think quality is the one that I like best. Unfortunately, quality often comes with high valuations, because you won't be the first person to notice that this is a quality company, where quality is defined as things like low leverage, good profit growth, good return on equity. All of these factors would feed into quality, but everyone sees the same numbers as you do, and that pushes up the price of quality. So you have to combine factors, which is why in the UK I've got this kind of quality, value, momentum combination portfolio. So I've got 3 different factors which feed into my portfolio. And in case you thought that was an impossible combination, it's not. So I use Stockopedia. I use a filter on Stockopedia to generate that screen. This is what the screen looks like. I can share that. So it comes up, Stockopedia comes up with summaries of fundamentals. So there's a quality rank, a value rank, and a momentum rank. So I screen based on those factors. They've all got to be over 50. It's got to be a small cap. So the market cap's got to be more than 100 million, because I don't want micro caps, and less than a billion. It's got to be liquid. So the bid offer spread can't be more than 5%. I learnt that the hard way. And then these are the stocks which score best based on those criteria. So this is sorted by overall stock rank. So you can see Sarabi Gold looks good, Jupiter Fund Management, MP Evans, S&U, Polar Capital, and so on. So currently I've got this lot in my portfolio, and I just keep an eye on these stock ranks, and if it falls below about 80, then I start to think, maybe I should sell this one. So this one, Costain, has fallen pretty sharply, and the share price has fallen pretty sharply as well. So that might be one which I take out, or these two, Norcross, Alton Gold. These two might come out as well. But I try to keep it objective. I don't get attached to the names in any way whatsoever, but I try to keep it kind of fundamentally based. But it keeps my interest because I kind of look at the names. Sometimes I research the names and the companies, and it's interesting to see what boils to the top of the heap based on these criteria. But it's something I'm going to stick with. So that's why I chose it, because it was a combination of factors which I believe in. I think that combination is a set of criteria for a good company, and that won't change ever. So that's why I'm quite happy to stick with that strategy. Whereas you should never buy a strategy based on the fact that it's worked well over the last year, and then suddenly abandon that and jump to another strategy because its price has gone up. Because it's not just about price, it's about believing in the actual principles behind the strategy and why it's working. So that's, I think, really important. It's got to be in kind of line with the way you think. That's why Warren Buffett managed to stick to an investment style over a very long period of time. And one of the big warning signs for a fund manager is when they get style drift, when whatever they're doing stops working and they say, oh, scrap it. Let's not do that. Let's do this. It's really hot. They just chase the next red shiny ball. So that's always a worrying thing with an active fund manager or with individual people running their own money. So I think that's why you've got to find something which you're happy with, which you can stick with, because it's not going to work, frankly. I don't think you'll be able to identify a strategy based on just momentum, on just which ones are working. Next question is from Simon. Oh, very generous. Thank you, Simon. He says, "What are your views about the Prosper platform?" Do you work for Prosper? Aside from that, it can only be used via a phone app, and it has a relatively limited set of investments to choose from. So let's fire up Prosper. Actually, let's just see. PensionCraft.com. So what we do is we have a list of platforms now, which my colleague Hannah has created for us. So what we try to do is rank platforms, and we've also got a list of cheapest funds. Let me just share that with you. So as a member of the community, you get access to our website and some proprietary tools. So you get this yield curve stuff. You can look at UK gilt yields. Oh, look, they're going up, except for the short end, which is going down. But we've also got, let's look at cheapest ISA platforms. I wonder if we've got Prosper as one of them. If we haven't, maybe we should add it. No, we haven't. Okay. So that could be an interesting one to look at. Prosper platform. Here we go. So what is it? So it's DIY investing, 150 index portfolio mutual funds and ETFs. I have come across it before, but I haven't used it myself. It's got a SIP as well. Okay, got a general investment account, of course. Let's have a look at the fees. 0. That's good. They use scalable tech and retain interest on cash left uninvested. That's fairly standard now as well. How do they make money? The usual story, I guess. It's going to be unused cash. Yes. So the answer is not much. They probably don't make much money, but you know, as long as they manage to stay afloat, that's good. Because the fees are low, obviously. Fairly restricted set of investments by the look of it so far, but you know, presumably they're going to grow that over time. Oh, they've also got private market investments, which is kind of interesting. Not that I'd do that myself, but it is available. Okay, but yeah, I mean, it looks like another low-cost platform, and we should definitely add it to our list on PensionCraft. So let's see, you know, there are quite a few free platforms now. So if we do look at the list of cheapest stocks and stocks and shares ISA platforms, let's say that you've got ETFs, because whether you hold ETFs or funds, OEICs, makes a big difference to the overall costs. But you can see that you know, there are 3 platforms now: Invest Engine, Trading 212, and XTB, where you know the fees are almost 0, and the next tier up isn't far off 0. You know, I think it's £1 a trade. We assume that you make 12 trades a year, so I think this £12 would be 12 trades. So eToro, Interactive Brokers, and Lightyear would be the next rung up. And actually, Lightyear now, they don't charge, I don't think, for ETF trades. They've just changed their rules. ETFs are free now. So we did change the text there, but not the number. So it is a case that quite a few platforms in the UK now are nominally free. Obviously, you'll still pay the bid offer spread. A lot of them still pay you for, make you pay for currency conversions. So they do make some money from that. But yeah, it's interesting to see there's another one that's popped up. I wonder if, you know, there's a big question, I think, you know, how many of these platforms would the market be able to absorb and have them still be profitable? Because, you know, there are only so many clients in the UK, and there can only be so many free platforms, free-ish, which could be supported. So I wouldn't be surprised if we have some consolidation in that sector. But yeah, Prosper looks interesting, and we'll probably add it to the app and add it to our list of cheapest ISAs and SIPs. So thank you for that, Simon. That's interesting. And I'm sure they're going to grow their list of investments which you can invest in over time. Next question is from Anthony Bevington. And Anthony says, please could you explain what you might think about when deciding to buy currency hedged gold ETC versus unhedged, i.e. how sterling versus the US dollar affects return? So, yeah. Now, previously, my answer would have been quite different to the answer I'll give today. Previously, so let's go back to the old way things were. When people were scared previously, they would buy dollars, and dollars would strengthen versus the pound. Now, if gold is priced in dollars, then gold is kind of a safe haven asset like the dollar, and so what you'd expect to happen is that gold would be flattered even more in sterling terms than it would in dollar terms, because both the dollar and gold were safe haven investments. So if you're a UK investor, buying gold as a hedge, then you'd actually benefit from not currency hedging that back into sterling. So in a sense, gold is a currency, right? That's the first thing to understand. So you don't buy gold in dollars. It's priced in dollars, but you kind of experience the value of it in sterling. But as a UK investor, you actually benefit from the fact that sterling is seen as a risky currency, because in a crisis we'd sell off more than gold, and we'd actually see a larger percentage increase in the price of gold than someone who saw it in dollars. Fast forward to today, and the dollar's not seen as such a safe haven as it was, because of the fact that we've seen these erosion of norms in the US market, with central bank independence, firing the head of the statistics agency when they give a non-farm payrolls number that you don't like, even though it's a completely normal revision which has been revised down. You don't fire the head of the agency which produces the most important number in investing on a whim, right? So that tells me that the US is no longer reliable in terms of the data it provides, because the agencies which provide this data about the US economy will be scared about retribution from their own president. Secondly, the president in the United States is weakening the Federal Reserve's independence. And combine those two, and you've got a situation where that's not the behavior of a safe haven currency. That's the behavior of an emerging market currency. So, of course, the US is miles away from an emerging market at the moment, but that's the direction it's moving. So the US dollar isn't such a safe haven as it was when these institutions were sacrosanct. So that's why I think for the US investor now, actually gold is looking like a more attractive hedge, because their currency is no longer seen as a safe haven, and it'll probably weaken if there's a risk-off move, or at least it's more likely to weaken than it was previously when it would have strengthened. But yeah, I think the idea of a currency hedge for a gold ETC is kind of misleading, because as a UK investor you wouldn't want that, because it actually, if you're buying it as a hedge for equity market falls, you're better off not hedging anyway. You don't want it to cancel out the dollar versus sterling fluctuations. So that's my take on it anyway. At least that's why I buy gold. If you're buying gold because you think there's going to be a huge rally in gold, well, the question is, would that rally go hand in hand with sterling strengthening versus the dollar? Frankly, I don't think that's the case. But that's the kind of thinking that goes behind whether you hedge or not. Is the thing which drives up sterling versus the dollar the same thing that would drive up the price of gold? So that's what you should be thinking. And if that's, and then you decide which risk you want to take. But overall, I'd never currency hedge my gold holding, because I already think of gold as a currency anyway. So when I buy gold, I'm looking at sterling versus gold, not the dollar versus gold. Next question is from Amir Ketobji, who says, "Nice to see you, Amir." A very generous super chat, thank you. He says, "Another frequent flyer. Indeed you are, Amir. There's a lot of nervousness about the UK economy by serious people at the moment. What do you think would trigger a meltdown? Keep up the good work, Amir." Well, I think a populist government would definitely be a problem for the UK. By which I mean looking at what happens in the United States and copying it. So saying that the Bank of England might not be independent, or a UK Prime Minister deriding the head of the central bank. Behind closed doors, of course they do. They're just human. But in public, no. Firing statistics agencies, that kind of action where you don't trust the statistical data, and I think all of that would be very worrying. But the UK is far from that at the moment. I think we're moving towards potentially a more populist form of government, like the US has, like much of Europe has, where that kind of thing isn't as unlikely as it is now. And that would be worrying. But would the economy be, is the UK economy stuffed? Is it over? I think there are certain structural problems with the UK economy. We've got many things which we can't afford, which we're going to have to cut back on. Things like the triple lock for pensions. It's ridiculous that we've still got that in place. And it's simply unsustainable, where you've got pensions rising by the greatest of 2.5%, earnings growth and CPI inflation. You know, that's a crazy situation because it's just not sustainable. You know, remove two parts, you know, one part of the lock, keep it inflation linked or wage linked. But having the triple lock, I think, is just too much of a good deal. And it's making UK state pension just unserviceable. How much we spend on other things like services, it also seems to be unsustainable. The National Health Service, probably. You know, it's always requiring more money. And, you know, the question is, should we decide to have something which is more split between the private sector and the public sector? You know, is it affordable not to have at least some of healthcare provided privately? I mean, it already is effectively a two-tier system. If people want to get off waiting lists, they're already going private if they can afford it. But not obviously go down the road of the US, which doesn't have really much of a state National Health Service at all. But what I'm saying is there are some big structural reforms which have to happen in the UK because we can't afford the lifestyle that we've grown accustomed to based on the growth that we're seeing in our economy. So, you know, either we massively bump up growth, and both Conservatives and Labour have failed to do that so far, and I'm not hugely convinced they'll manage to boost it hugely from where we are today, or we spend less and just resign ourselves to the fact that we can't afford such largesse and you know, don't run a deficit. You know, I think that's one of the good things about this current government, which is that they're really careful about debt to GDP ratios. Whereas in the US, in Europe, some countries in Europe, they've essentially grown quite happy about having deficits. So I think there's a lot of good stuff to come out of the UK. The UK is still a very well-educated society. We've still got very good universities. We've got a good rule of law. We've got English, which is a big export around the world. So culturally, we export a lot of great content, YouTube, for example, but also movies, music, you know, all of that stuff. We really do punch above our weight as a small country. So I'm still quite optimistic about the UK. So I don't think it's going to hell at all. You know, I think we've actually got a managed decline, put it like. But you know, if you look at the size of our market cap, for example, for our equity market, it's not hugely out of line with, you know, GDP. In fact, I think it's roughly in line. So, you know, I think we've just got to resign ourselves to our place in the world as a small country. But yeah, I don't think it's going to. I don't think it's going to hell. Anyway, look, thank you all for joining us, and please do like and subscribe. Please do watch our content, and hopefully give us feedback about it. And hopefully, I'll be able to sort out my digitization stuff and my camera equipment to improve my videos. I'm always trying to improve them. And yep, if you do want to join our community, you can do that very easily. Just go to pensioncraft.com/membership to learn more. You get access to those trackers that you saw. We're releasing a new app which will allow you to backtest your portfolio. we're adding new things all the time in terms of the trackers. We're just about to add a new thing where you can actually see the cash flows for any bond in the UK, any gilt in the UK, a smaller list. And yeah, so do think about that. And you can chat to me anytime you like on our chat application in the community, and you can chat to other members of the community. So yeah, and then the podcast, completely free weekly market roundup, pensioncraft.com/newsletter to learn more about that. And for the membership, pensioncraft.com/membership. So anyway, thank you all for joining us, and good luck with your portfolios. Hopefully things will be better next time we talk, and markets will have done well. Take care, everyone.